Hi folks, I'm Bob Binney.
I'm Jessie Thompson.
And we're both certified financial planner professionals with Bob Binney Wealth Management right here in Lincoln, Nebraska. And welcome to today's Bobcast. What's the topic of today's Bobcast, Jess?
The topic of today's Bobcast is the market overvalued? The stock market, as measured by the S&P 500, is it overvalued? Have you read any articles or seen anything on the news that said, oh, the stock market's in a bubble right now. All the prices are just so high. There's always some kind of article like that. It doesn't matter what the stock market is doing.
Yeah. They're all about trying to create news, trying to scare people, that sort of thing. So what people are talking about when they say overvalued are the companies valued more than they should be. Basically more than they should be based on what they're earning. And so there's a tool that we use to measure how the companies, each individual company in the S&P 500 market, for instance, as a whole, that's called the PE ratio. It's known as the price earnings ratio. It's basically how many times earnings the company is valued at, or is it selling for. It's the current stock price divided by the company's earnings per share, basically the price of the stock for every $1 of earnings.
Now, that price to earnings ratio by itself doesn't really mean anything, but what's useful for it is when you're evaluating a stock, you can look at the PE ratio of a certain stock versus other stocks, other companies that are like it, or categories of companies that are like it, and say, is this particular company really expensive relative to how much money they're actually earning compared to other ones that are like it? Or historically, you can say, is this a good time to buy this company? Is it more expensive right now relative to its earnings than it has been in the past? And you can also do that with indexes such as the S&P 500.
The quote-unquote market. So why do these market bears say that the stock market's overvalued? There are people who always say that. That's their thing. They're always saying that the stock market's overvalued. They're always doom and gloom. It's about to crash, it's about to crash, it's about to crash. But then there's also just, because the market's gone up a lot in the last years, it went up a lot last year, went up a lot the year before, it's going up pretty good this year. They think it's going to go down, and eventually they'll be right, it'll go down some, because it always does. But the average ratio of price to earnings, this tool we're using to measure valuation of the S&P 500 over the last 30 years is about 25. So companies are selling for about 25 times their annual earnings. Currently, the S&P 500 average PE ratio is about 29. And yeah, 29 is a little higher than 25. However, earnings are growing. And the expectation of future earnings, that's another calculation we can use, forward earnings, they call that, is only 22. So it's okay for the S&P 500 PE ratio or of any individual company to be higher than the average of its peers, as long as they're growing their earnings healthy, and doing well. So the economy's doing well. These companies are making money and they're growing their profits. And so that's why their stock prices are going up.
And another thing to consider too is considering that forward price to earnings ratio. It's based on analyst expectations of what the earnings for the companies are going to be in the future. What has been happening for the past, three or four years, is that consistently on a quarterly basis, the companies on the S&P 500, by and large, like this last quarter, 81% of them, and that's around what it normally is. It's like between 75 and 80. Usually exceeded the analyst expectations for what the earnings were going to be, and by a lot.
Yeah.
And so that forward PE ratio isn't even considering the fact that probably the earnings are going to be even higher than what the analysts are expecting.
So earnings drive value. we should be concerned if prices are high but earnings slow down. But as long as future earnings continue to grow, they can justify the high prices of these stocks. We're in a technological revolution. Whether you call it technological revolution or an information technology revolution or whatever, we've been experiencing that, and it just keeps accelerating. And so artificial intelligence is changing the world, technology is changing the world, and boosting corporate productivity in all kinds of businesses, including our own.
And efficiency. And so hence that boosts the earnings and the profits of the companies on the stock market. So we're in an age that is different than what the world has been and what the stock market has been like over the last 30 years because of this exponential growth that technology is
Right.
giving these companies. So bottom line, we believe that the proven earnings that come out every quarter and exceed the analyst expectations, the expected earnings growth, which are high still, and the technological revolution that we're in warrant the current prices of the stock market. It's not a bubble when there's actual value and growth behind the prices of the companies on the stock market. So now is still a great time to invest. We're not at like the peak. We don't think we're in the peak right above
Right.
a market crash or anything like that. It's still a great time to invest, and we'll talk a little bit more about that in our next Bobcast as well.
So thanks for tuning in to today's Bobcast. If you enjoyed this, if you feel it's of value, tell your friends about it, like and subscribe to it, and we hope you have a blessed day.
Thank you very much.